Epstein. I am still out of town. I will be returning midweek to Chicago, but I've kept up pretty much with what we said we would. And what an interesting week. If you take a look at the market, there's a dichotomy staring you in the face. Just take a look. You've got the stock indices up right across the board here. All of these, as you can see, sharply higher, right? Then we start going to the energies, which are lower. The cotton down 300, bonds and notes lower, November Bitcoin lower, all of the metals down, most currencies lower with the exception of the pound, which has been resurrected from death under 104 to over 116 now. But remember, we're still to get the details of what Mr. Sunak is going to be giving us. And then we step over to the grains, which were mixed, corn and wheat lower, but the beans higher. So what gives? Well, in the stock market, it's one of never-ending hope that what will take place is that the Fed will give us a 75 basis point hike now and suddenly say in some manner that the inflation numbers are beginning to act as though they're stalling or peaking, and that in somehow December will go to a 50 basis point hike, and then we'll be moving on in January to 50 to 25 basis point hikes and ending somewhere between 4.75% and 5%. That's all wonderful, and the market has built that in. The problem is that we haven't seen the CPI numbers and the jobs data yet to prove or give us really that hope. It is just that the market is anticipating that. Is that uncommon? Nothing's uncommon before you get into a Fed meeting. Please understand that. You go to these meetings and anything can happen. When we come and take a look at a monthly chart of the S&P, we can see that the market is sitting here still well under the 18-month average, which would be at the 42, 59, 50 level, right in that general zone. Okay, so you still have bias on a monthly basis to the downside. When we take a look at a weekly bar chart, we're getting a nice bounce off these lows. I can understand that. And when we look at the swing line, you're still bearish. You still have lower highs, lower lows. No getting away from that. I have been looking for the market to return on the weekly chart to the 18-week moving average of closes, at which point I have been hoping the market would run into the resistance. So far, that's happened. Where did the support show up? I teach in my charting course that the first challenge of a 200-day average or a 100-day average is often an important number. The market will tell you how important. Well, in this case, it's very important. The market got down here, if we take a look back over here, at the end of September, and it finally moved away in the last week of October to the 18-day average. Pure chart shorts. This is the spot they'll go short. They'll put a stop over the last time. They'll look to see, can the market retest the 3609 level? When you look at what happened, you had gotten a market that had gotten under a 30 level, and the market is now correcting that. However, the word is correcting, not corrected. You still have a 26.9 reading. To attract short selling, in my belief, the way I teach charting, you either embed where both the red and the blue go over 80 or go under and stay under 20. This market has shown a propensity to not want to get under and stay under 20. You can't argue that. It's staring you in the face. It's something that hasn't happened. Okay, so you correct what we'll call, I guess we can call it an oversold area that takes you back to the neutral number, the 18-day average. It also bounced away from the Bollinger Bands. The odds of staying under these bands are only 5% of the time. So everything pointed to an area that the market can lift from. When we take a look last at where we're at here, I think you're just looking at a market that wants to sit. We'll see what it can do, but I do think this is the area the pros could hit the market with some short ideas. The Dow is different. What has happened is the Dow is not a tech-heavy index. It is an industrial index. Think about the 30 companies that make it up. So what has happened here is you've gotten the energy companies and other companies that have surprised with better earnings, away you go. Where the surprise negative has been is in the NASDAQ. This market got up to last week, it's 18-week moving average of closes, and this week it took it out. So the bear trend in this market is now done. I know you're going to look at me like, what's he saying? It's done at this point. It has to reconstruct itself. Sure, you can tell me if it gets through this low that we're in another wave, but in terms of charting, you'd have to create a pattern of lower highs, lower lows to get bearish, and you don't have a pattern of higher lows, higher highs. So the next resistance spot is staring you in the face here. It is right here, the green line, the 100-week average of closes. The support turned out to be the combination of the Bollinger Band, you can see right through here, the Bollinger Band, and the 200-week average of closes. That takes us to the NASDAQ, which it too is fighting a battle at the 200-week average, but look at how much weaker it is than the other markets. You're not up to the 18-week average of closes. So for those that want to pursue the short side of the market, I think the market is telling you in plain English that this market right here, right through this area, that's the resistance, 12,087.5. The trade will probably put stops over this. Now, I'm not saying on a weekly chart to go out and risk 800 points. Please understand it. It gives you an idea of what to expect and where the markets are. In addition, look at how this market, similar to the other stock indices, doesn't like to embed. It's rare that it doesn't. So you're getting a correction in the market. It can run more. To correct, you either embed or you rally. And if you're going to rally, then that 12,087 level is in the cards. In the Russell, we have a situation where if we take a look here, the low of 1647.50, then we came down, made a low of 1643.80. So we made a lower low, higher high. You went up last week, challenged and played with, if you take a look at it, the 200-week average and the 18 right through here, where I'm flipping that for you. And now you're over. Okay. You've stepped out of your downtrend. You don't have a pattern of higher lows, higher highs. So the markets have put themselves in interesting patterns going into the Fed meeting, but it's still overall one where the market is betting very clearly that the Fed is close to not having to go with 75-point hikes and going with 50. Is that really bullish, the market? That is the bigger question. I mean, it's getting to a 4.75% to 5% number is still a big number. We then get to the 30-year bonds, which are coming down all the way along the lower Bollinger Band. The market settled under this band for a while, then came back and forth, as you can see. It is embedded. Until it loses this embedded streak, where it's got at least, three weeks in a row where the blue and the red are under the lower band, the odds favor the good rallies in the market get sold, and you come out of those on the first close when you're over 21 on the slow stochastic. In the 10-year, it is the same game plan. You can see how the market is now got, and follow me here, week 1, 2, 3. This is a week where obviously traders the smart money probably won't sell into the Fed meeting, but it, in theory, is you sell the rally. You come out if the red line closes over 21, and you look for a retest of the lower Bollinger Band. In the dollar index, there's been a rollover. It's very clear. Lower highs, lower lows, and a lost bullish embedded reading. Now that lost reading happened not this week, but last week. And what it sets up, unless you go right away back and embed or over eventually this high, you're going to get to that 18-week average before you get up to the high. That is what you learned from that momentum. And it's paid off in spades. This is a week down 137 points. So last week, it gave you an out before the market broke. The flip-flop happened in the euro. Now we can remove this, if you will. Line, don't need that. We've got higher lows, higher highs. We had lost the embedded reading. Step with me right through here. Watch. Right there. Before the market rallied this week to that 18-week average. That's one of the beauties of this. And now you're neutral in the market waiting to see what the Fed does. in the Canadian dollar. You know, you're hearing from the Canadian government and their actions. They want to pivot away from the higher rate hikes. What happened at the end of the week? You have a 21.38 reading. You're supposed to be out of shorts. So as far as my work is concerned, this bear phase of the market has run its course. Could it re-embed? It could. This week, you'd have to take both numbers and keep them back under 20. And if that doesn't happen, then the odds strongly favor a move back to the 18-week average of closes, the red line, wherever it comes in. That is not the case in the end. Now, in all fairness, it's taken 9 years for the Japanese government to get inflation close to where they want. When you strip out energy prices, the real inflation's around 1.6, 1.7. They're getting close to their 2% number. It's only taken them 9 years. But what they are missing is wage inflation. And how they get that is going to be, it could be a trip up for them. You got to be careful then. Is the market still a short sale on rallies? And the answer is yes on a weekly chart. As this market has not lost its embedded reading until it does, there's a number that I teach in my enhanced Bollinger Band course and a moving average that you're a seller at, and you're out if you lose the number, and you're buying back if you can get down to the lower Bollinger Band. Bitcoin, on a weekly chart, the market has now come up. The last rally high was 205.35, and you have gone up to 21,000. So in reality, what has happened is this number should be pointing up from here, right there. You now have a lower low, higher high. You are out of the downtrend. What about the embedded reading? Follow me right here. You lost it. So officially, I am now no longer in the bear camp in Bitcoin. I haven't joined the bull camp. I am waiting. I see the market caught between the upper and lower Bollinger Bands, but it is a sign the market is bottoming out. In the differential between Brent and WTI, you can see the market keeps trying to hold this 18-week average of closes, which is overall friendly for the Brent. Now, when we take a look at the patterns here, we have higher lows, higher highs, but unable to close over the 18-week average of closes. Therefore, I'm still looking to see, can this market get up and run, if you will, up to this number up here, the upper Bollinger Band, if it can close over that number. Hasn't proven that it can. The market fails and gets bearish again if you get down under 88.77 this week. So you're at a very important number right here. When we look at WTI crude, it's the same thing. Higher lows, higher highs. You had lost the bearish embedded reading. The work then said, watch this, that you should go for the 18-day average. You lost it right here, and you hit it back up here, and you're testing it again. So we are at a crux. What is going to happen right here? I can tell you that over the weekend, one of the things that happened is the Biden administration doesn't sound like they're getting too close to going with a cap on energy prices from Russia with our NATO allies in Europe. And that is because midterms are here. The Biden administration doesn't want to do that. And that puts off the December 5th date that was originally on the table for the caps. And the reason is, if you calculate the ship traveling from Russia to Europe and so on for the ports of oil that they still get, the oil by the time it arrived would be under the sanction rule. That doesn't make any sense. So something different is going to happen through that. We then step over to Reebok gasoline, and you are back up to the point where this hurts the Biden administration for the midterms. It has come off the lows. It held beautifully the 100-day average combination in the Bollinger Band. You were running it till you got down there, and now you're back up here. There's nothing left bearish on this chart. If anything, you're bullish again. You got to close at 290.66 over the 18-week average, and until prices get back under 24 to 49.05, until they break that, I'm looking for gradually higher prices. Be careful, because I understand Ukraine has struck the Russia's Black Fleet in Crimea. It didn't appear that it did serious damage, but the fact that it hit it got Russia angered, and this happened today, and Russia has announced it is pulling out of the UN brokered grain deal, that its ships aren't safe, and they are through with that deal. So what will that do to the food that is backed up? In reality, Russia hasn't lived up to the deal. There were 170 ships backed up trying to get out of port. They have played games all the way through. And in the latest part, they are blaming the United Kingdom for helping Ukraine bomb with those drones the fleet. And now they have evidence that proves that the UK has destroyed the Nord Stream pipeline. It was them that blew it up. Okay, so that's their part. But one of the things that you see is over and over, I keep talking to you about Bollinger Bands, the importance. Take a look at this.
Welcome. I'm Ira Epstein, and I'm here to talk about my enhanced Bollinger Band course. Now, many of you have taken my regular charting course, and if not, you might think you know something about Bollinger Bands. As you know, Bollinger Bands are an algorithm designed to keep the market trading within it 95% of the time, and on a chart it will offer on the top part resistance, on the bottom support, and the idea is the market will travel within them. We know that sometimes it latches onto that band, goes up or goes down. Well, how do you play with that? Can you pyramid the positions off that type of thinking? Well, I've applied all three of these into 13 different videos that teach you my concept of it. And from that concept, you're able to work with weekly charts and or daily charts. The 13 videos, each about 7 minutes long. The idea here is not to put you in school forever, but to teach. Now, if you haven't tried my complete futures research, I throw that in as well. Whether you've tried this or not, I think it's worth taking a look at. I think you're going to learn something from there. That research, by the way, covers twice daily market updates for you and access to what I call window envelope numbers, which I think are very important when looking at these Bollinger Bands. The next part is a trial to our charting software so you can make your charts look the same way that mine do. It's that simple. Where do you go with it and how do you get all this? It's simple. You go to our website, www.iraepstein.com. If you go to the word education, everything you need is answered there. You can also call my staff. They'll be happy to help you get set up. I'm Ira Epstein, on the road to your education.